dangerous, a dead bomb sitting in plain sight that could wipe out trillions of dollars in wealth overnight, and it's not where you think it is. In 2008, Lehman Brothers collapsed. One investment bank, and within weeks, the entire global financial system was on the verge of total meltdown. Banks stopped lending, stock markets crashed. Governments had to inject trillions of dollars just to prevent a complete economic collapse. One domino fell, and it nearly took down everything. Now imagine something way bigger. Not one bank. An entire country, with an economy so large and so interconnected with every other economy that if it goes down, it takes the whole world with it. This isn't a hypothetical. This is a real threat that economists and policymakers are quietly freaking out about. Because there are nations out there carrying debt loads so massive, so unsustainable, that collapse isn't just possible. It's becoming probable, and when it happens, your savings, your job, your retirement, everything could disappear faster than you can imagine. By the end of this video, you're going to understand exactly how the debt crisis works, which countries are sitting on time bombs, and what happens when one of them finally explodes. Because this isn't about economics, textbooks. This is about the real-world disaster that could reshape your life in ways you're not prepared for. Let me start by explaining what sovereign debt actually is. When a country spends more money than it collects in taxes, it has to borrow to make up the difference. Just like you might take out a loan to buy a house. Governments issue bonds to borrow money. Investors, both domestic and foreign, buy these bonds. The government promises to pay them back with interest over time. This is sovereign debt, national debt, and almost every country has it. The United States has over $34 trillion in debt. Japan has over 10 trillion. China has over 13 trillion. The European Union collectively owes over 15 trillion. These are numbers so large, they're almost meaningless to the human brain. But here's what you need to understand. Debt isn't automatically bad. If you borrow money to invest in education or infrastructure or technology that makes your economy more productive, that debt can pay for itself. It's like taking out a student loan. Yes, you owe money, but if that education helps you earn more, it's worth it. The problem comes when countries borrow money to pay for things that don't generate future growth, when they borrow to pay for current consumption, or when they borrow so much that the interest payments become crushing. That's when debt becomes dangerous, and we're seeing this happen in multiple countries right now. Let's start with the big one. Japan. Japan has the highest debt to GDP ratio of any major economy. Over 260%. That means their total debt is more than 2.5 times the size of their entire economy. To put that in perspective, if Japan's economy produces $5 trillion worth of goods and services in a year, they owe over $13 trillion. How did this happen? It started in the 1990s when Japan's real estate and stock market bubbles burst. The economy crashed. Growth stalled. The government responded by spending massively on stimulus programs to try to restart growth. They borrowed and spent for décadas. The problem is, it didn't work. Japan's economy has barely grown for 30 years. They call it the lost decades, but the debt kept piling up. Now Japan is in a trap. They can't cut spending significantly because that would crash the economy even more. But they can't keep borrowing forever because at some point, lenders will lose confidence. Right now, Japan gets away with it for two reasons. First, most of their debt is owned domestically. Japanese citizens and institutions hold about 90% of Japanese government bonds. So the money they owe is mostly owed to themselves. Second, interest rates in Japan have been near zero or even negative for years. So even though they have massive debt, the interest payments are manageable. But this creates a fragile situation. If interest rates rise, suddenly the cost of servicing that debt explodes. If Japanese citizens lose confidence in their government's ability to repay, they might stop buying bonds. And if Japan can't borrow anymore, they'd have to either cut spending drastically, which would crash the economy, or print money to pay their debts, which would cause hyperinflation. Either scenario would be catastrophic, and because Japan is the third largest economy in the world and deeply integrated into global trade and finance, a Japanese debt crisis would send shockwaves everywhere. Now let's talk about China. China's debt situation is different, but potentially more dangerous. Official government debt is around $13 trillion, which is about 80% of GDP. That's high, but not catastrophic. The problem is that official government debt only tells part of the story. China has massive amounts of hidden debt in local governments and state-owned enterprises. Local governments in China have borrowed heavily through off-balance sheet vehicles to fund infrastructure projects. Estimates put this hidden debt at anywhere from $8 to $15 trillion. Add it all up, and China's total debt might be over 170% of GDP. Why is this a problem? Because much of that debt was used to build things that don't generate economic returns. Ghost cities, redundant infrastructure, bridges to nowhere. China was growing so fast for so long that they could keep borrowing and building, but growth has slowed dramatically. And now they re-left with massive debt and assets that don't produce enough income to pay it back. This is showing up in the real estate sector. Chinese property developers borrowed billions to build apartment buildings. But there's oversupply. Prices are falling. Developers are defaulting. Evergrande, once China's largest developer, collapsed with over $300 billion in debt. That's bigger than Lehman Brothers, and it's not alone. Multiple Chinese developers are in trouble. The Chinese government has been trying to manage this carefully. They're providing liquidity. They're restructuring debts. They're trying to prevent panic. But the fundamental problem remains. There's too much debt and not enough growth to service it. And China is deeply connected to the global economy. They're the world's largest exporter. They're the biggest trading partner for over 120 countries. If China's debt bubble bursts and their economy crashes, it would immediately impact every country that trades with them. Supply chains would break, commodity prices would collapse. Global growth would stall. It would make 2008 look small. Now let's look at Europe. The Eurozone has a unique problem. They have a common currency, but separate fiscal policies. That means countries like Germany and Greece both use the euro, but they have their own governments making their own spending decisions. This creates stress. Some countries, like Greece, Spain, and Italy, have high debt loads. Italy's debt is about 140% of GDP. Greece, even after being bailed out in the 2010s, still has debt around 170% of GDP. These countries are vulnerable to crises. We saw this play out in the European debt crises of 2010 to 2012. Greece was on the verge of defaulting. If they had, it would have triggered a cascade. Banks holding Greek bonds would have taken massive losses. That would have spread to other weak Eurozone countries. Spain, Portugal, Italy. They all would have been at risk. The entire Eurozone could have collapsed. The European Central Bank had to intervene massively, buying bonds and providing unlimited liquidity to prevent disaster. They managed to hold things together, but the underlying problems haven't been fixed. Southern European countries still have high debt and weak growth. Northern European countries are tired of bailing them out. Political tensions are rising, and if another crisis hits, it's not clear that political will exist to save the Eurozone again. If Italy, with the third largest economy in Europe, had a debt crisis, the European banking system would be in serious trouble. Italian banks hold massive amounts of Italian government bonds. If those bonds lost value, the banks would fail, and European banks are interconnected with banks worldwide. A European banking crisis would immediately become a global crisis. Let's talk about the United States. The US has the largest absolute debt in the world, over $34 trillion and climbing. That's about 120% of GDP, and it's projected to keep growing. The Congressional Budget Office estimates that without policy changes, US debt could reach 200% of GDP by 2050. Why is US debt growing so fast? A combination of factors. Tax cuts that reduced revenue, spending increases on defense, social programs, and healthcare, and interest payments on existing debt, which are becoming one of the largest items in the federal budget. The US has advantages that other countries don't. The dollar is the world's reserve currency. Global trade is conducted in dollars. Central banks hold dollars as reserves. This means there's always demand for US dollars and US Treasury bonds. The US can borrow at lower interest rates than any other country because treasuries are considered the safest asset in the world. But this privilege isn't guaranteed forever. If confidence in the US government's ability to manage its finances erodes, that could change. We got a taste of this in 2011 when Standard & Poor's downgraded US debt for the first time in history. Markets freaked out. It turned out to be a temporary panic, but it showed that US debt is not infinitely expandable. If the US ever actually defaulted on its debt, or even came close, it would be the financial equivalent of a nuclear bomb. US treasuries are the foundation of the entire global financial system. They're used as collateral for countless transactions. They're the benchmark against which all other interest rates are set. They're held by every major bank, pension fund, and central bank in the world. If treasuries suddenly became risky, every financial calculation would be thrown into chaos. Interest rates would spike. Credit would freeze. Asset prices would collapse. We're talking about a potential depression that would make the 1930s look mild. Now here's where it gets really scary. All of these debt problems are interconnected. Countries and financial institutions are linked through trade, investment, and debt holdings. When one country gets in trouble, it spreads. Let me walk you through how a debt crisis in one country can cascade globally. Let's say China's property bubble finally bursts completely. Property developers default en masse. Chinese banks, which lent heavily to these developers, face massive losses. To stay solvent, they have to sell their holdings of foreign assets. That means selling US treasuries, European bonds, whatever they have. This selling pressure drives down bond prices and pushes up interest rates globally. Higher interest rates make it more expensive for everyone to borrow. Companies that were counting on cheap credit suddenly can't refinance their debts. Some start defaulting. Stock markets, which were propped up by low interest rates, crash as borrowing costs rise and corporate profits fall. Pension funds and insurance companies, which are heavily invested in bonds and stocks, suffer huge losses. This threatens their ability to meet their obligations to retirees and policyholders. Governments have to step in with bailouts, but governments are already heavily indebted. To fund bailouts, they have to borrow even more. But investors are now worried about government finances. They demand higher interest rates to lend. This makes the debt problem worse. Some countries reach a breaking point. Let us say, Italy can't afford to pay the interest on its debt at the new higher rates. They're forced to either default or restructure their debt. Italian banks, which hold massive amounts of Italian government bonds, collapse. The European Central Bank tries to prevent contagion by buying Italian bonds and providing liquidity to banks. But this is seen as printing money, which causes inflation fears. The euro starts to fall. German and other Northern European citizens are furious that their central bank is bailing out Italy again. Political pressure builds to leave the euro. If Germany or other strong countries left, the euro would collapse. Countries would return to national currencies. The value of euro-denominated debts would be thrown into question. Who owes what? In which currency? It would be legal and financial chaos. Meanwhile, the crisis is hitting emerging markets hard. Countries like Turkey, Argentina, Brazil, they borrowed heavily in dollars during the years of low interest rates. Now the dollar is strengthening as the US raises rates and investors flee to safety. Suddenly the debt these countries owe in dollars is much more expensive in their local currencies. Some are forced to default. This triggers capital flight. Investors pull money out of emerging markets. En masse, currencies collapse. Inflation spikes, political instability follows. Global trade starts to seize up. Banks are so worried about counterparty risk that they stop extending credit for trade. Normally, international trade is facilitated by letters of credit and other financial instruments. But if banks don't trust each other, this system breaks down. Goods pile up at ports, supply chains break. Companies can't get the parts and materials they need. Manufacturing slows. Unemployment rises. We're now in a full-blown global depression. GDP is contracting in most countries. Unemployment is soaring. Governments are struggling to respond because they're already buried in debt and can't borrow more. Some resort to printing money, which causes inflation or even hyperinflation. Others cut spending drastically, which deepens the economic contraction. Social unrest follows. People who've lost their jobs and savings are angry. They protest. They riot. Extreme political movements gain traction. Nationalism rises. Countries turn inward. They impose trade barriers trying to protect domestic industries. This makes the global economy even worse. We're now in a vicious cycle. Economic crisis leading to political instability, leading to worse economic policy, leading to deeper crisis. This isn't science fiction. This is exactly the kind of cascade we saw starting to happen in 2008. And we only prevented total collapse through unprecedented government intervention. The US, Europe, and China all spent trillions on stimulus and bailouts. Central banks cut interest rates to zero and beyond. They bought trillions in bonds through quantitative easing. Essentially, they threw everything at the problem. And it worked barely. But the cost was that all those countries are now heavily indebted, which means they have much less ammunition to fight the next crisis. Let me tell you about some specific mechanisms that make contagion happen. First, there's the banking system. Banks in different countries lend to each other constantly. This is how the global financial system works. But it means that if banks in one country get in trouble, it immediately affects banks everywhere. In 2008, when US subprime mortgages started defaulting, it hit European and Asian banks that had bought those mortgage-backed securities. The crisis spread in days. Today, banks are somewhat better capitalized than they were in 2008. But they're still interconnected, and exposure to sovereign debt is a huge risk. European banks alone hold over €1 trillion in government bonds from Eurozone countries. If those countries defaulted, it would wipe out huge amounts of bank capital. Second, there's the derivatives market. Derivatives are financial contracts whose value is based on some underlying asset. Credit default swaps, interest rate swaps, currency swaps. The global derivatives market is estimated at over $600 trillion in notional value. That's not all real money, but it represents exposure. These contracts are interconnected in complex ways. When something goes wrong, it can cascade through the derivatives market in unpredictable ways. In 2008, AIG nearly collapsed because of credit default swaps they'd sold on mortgage-backed securities. The US government had to bail them out with $185 billion, because if AIG had failed, it would have triggered defaults on swaps held by banks worldwide. Third, there's asset price correlation. In a crisis, everything gets sold at once. Investors panic and move to cash and safe assets. This means that assets that normally aren't correlated suddenly all drop together. Stocks fall, corporate bonds fall, real estate falls, commodities fall, everything except cash and the safest government bonds. This happened in 2008 and again briefly in 2020 during the COVID panic. When this occurs, investors who thought they were diversified find out their portfolios are all falling simultaneously. This triggers margin calls, forced selling, and a downward spiral. Fourth, there's psychological contagion. Markets are driven by human psychology as much as fundamentals. When investors see a crisis in one country, they start wondering what other countries might be at risk. They pull money out of anywhere that seems remotely similar. This is what happened in the Asian financial crisis of 1997. It started in Thailand, but investors panicked and pulled money out of Indonesia, South Korea, Malaysia, even though their situations were different. The fear spread faster than the actual problems. Let me tell you about some warning signs we're seeing now. Interest rates have been rising globally. Central banks, led by the US Federal Reserve, have been raising rates to fight inflation. This is making debt service more expensive for everyone. Countries that could manage their debt at 2% interest suddenly struggle at 5%. We're already seeing stress. The UK had a bond market crisis in 2022 when yields spiked and threatened pension funds. The Bank of England had to intervene. Pakistan, Sri Lanka, and Lebanon have all faced debt crises recently. These are smaller economies, but they're canaries in a coal mine. There's also the problem of unfunded liabilities. The debt numbers I've been talking about are official government debt, but many countries have much larger obligations that aren't counted as debt. Social Security and Medicare in the US, pension obligations in Europe and Japan. These are promises governments have made to pay benefits in the future. The present value of these unfunded liabilities is estimated at over $200 trillion globally. That's money governments will have to come up with somehow, either through higher taxes, which will slow economic growth, or through higher borrowing. which adds to the debt problem, or through benefit cuts, which will cause political backlash. Demographics make this worse. Most developed countries have aging populations, more retirees, and fewer workers. This means less tax revenue and more spending on pensions and healthcare. Japan is the most extreme example. Nearly 30% of their population is over. That ratio is only going to get worse. China is facing a similar problem. Their working-age population is already shrinking. Europe, too. The US is better off demographically, but still facing pressures. This demographic shift is a slow-moving crisis that's going to stress government finances for decades. Let's talk about what happens in an actual default. When a country can't pay its debts, it has a few options. First, it can try to negotiate a restructuring with creditors. This means asking bondholders to accept less than they're owed. Maybe they get 70 cents on the dollar instead of the full amount. Or maybe the repayment schedule gets extended. Greece did this in 2012. Bondholders took a 50% haircut. Argentina has done this multiple times. Restructuring is messy and takes years of negotiations, but it's better than a complete default. Second, a country can try to inflate away its debt. If you owe $1 trillion and you cause inflation, the real value of that debt decreases. The nominal amount stays the same, but it's worth less. This is essentially what the US and other countries did after World War II. They had enormous debt from the war. They kept interest rates artificially low and allowed moderate inflation. Over time, the debt-to-GDP ratio came down as the economy grew and inflation eroded the real value of the debt. But this only works if the debt is in your own currency. If you owe debt in foreign currency, inflation doesn't help. In fact, it makes things worse because your currency loses value, making the foreign debt more expensive. Third, a country can default outright. Just stop paying. This is the nuclear option. It destroys your credit rating. You won't be able to borrow from international markets for years. Foreign investors will sue. Your currency will likely collapse. Your economy will face severe recession. But sometimes, countries have no choice. They literally don't have the money to pay. Russia defaulted in 1998. Argentina defaulted in 2001. Lebanon defaulted in 2020. These defaults caused immense pain domestically, but in some cases, they were necessary to reset and start rebuilding. The scariest scenario is when a major economy defaults. Not a small country that can be isolated, but a large, interconnected economy. If China or Japan or a major European country actually defaulted, the global financial system doesn't have good mechanisms to handle it. The International Monetary Fund exists to help countries in crisis, but the IMF's resources are limited. They have about $1 trillion available. That sounds like a lot, but it's not nearly enough to bail out a major economy. When Greece needed help, it was a combined effort of the IMF, European Central Bank, and European Commission, and Greece's economy is tiny compared to Italy or Spain. If a major economy defaulted, we'd be in uncharted territory. It would require unprecedented coordination between governments and central banks worldwide, and it's not clear that political will exist. We saw how difficult it was to coordinate a response in 2008, and that was when the crisis was clearly centered in the US financial system. A debt crisis involving China or Europe would be even more complex politically. Let me tell you about some scenarios experts are worried about. One is a sudden shift in the dollar's status as reserve currency. Right now, central banks around the world hold dollars as reserves. This creates constant demand for dollars and dollar-denominated assets like US treasuries. But there's growing talk of alternatives. China has been trying to promote the yuan for international trade. Some countries are discussing trading in euros or even creating new currencies. If the dollar's reserve status erodes significantly, demand for US treasuries would fall. That would push up US interest rates and make America's debt much more expensive to service. It could trigger a crisis. Another scenario is a chain reaction starting with corporate debt. Global corporate debt is over $80 trillion. A lot of companies borrowed heavily during the years of low interest rates. As rates rise, some of these companies won't be able to refinance their debt. They'll default. If enough companies default, it hurts the banks that lent to them. Bank failures trigger concerns about government finances, because governments might have to bail out banks, and suddenly a corporate debt problem becomes a sovereign debt problem. The third scenario involves climate change. This might seem unrelated, but think about it. Climate change is already causing more frequent and severe natural disasters. Hurricanes, floods, wildfires, droughts. When these hit, governments have to spend money on disaster response and rebuilding. Insurance companies take huge losses, and some are already pulling out of high-risk areas. Countries that face repeated climate disasters might find their finances stressed to the breaking point. Small island nations are particularly vulnerable, but even larger countries could be affected. Think about what would happen if a major hurricane directly hit New York or Miami with catastrophic damage. The economic cost would be in the hundreds of billions. The government would have to borrow to fund recovery. Add that to existing debt problems, and it could push things over the edge. There's also the risk of political dysfunction making debt problems worse. Solving a debt crisis requires difficult decisions. Spending cuts, tax increases, structural reforms. These are politically unpopular. Leaders who propose them often lose elections. So there's a tendency to delay and hope the problem solves itself. We see this in the US with the recurring debt ceiling fights. Congress can't agree on fiscal policy, so they just keep raising the borrowing limit and kicking the can down the road. Eventually, markets might lose patience. If investors conclude that political dysfunction means problems won't be solved, they'll demand higher interest rates for risk. That makes the debt problem worse and creates a death spiral. Japan is an interesting case study in political dysfunction and debt. They've had over 30 different prime ministers since 1989. Governments change frequently. No one has been able to implement serious reforms to address the structural problems in the economy and the debt. They just keep muddling through with monetary stimulus and government spending. It's worked so far in the sense that they've avoided crisis, but they haven't achieved real growth either. The economy has stagnated for 3 decades. This might be the future for other highly indebted countries. Not dramatic collapse, but decades of slow growth and declining living standards. Let me talk about what ordinary people can do to protect themselves. First, understand that if a major debt crisis hits, almost no one is completely safe. Your bank deposits are probably insured up to a certain amount. In the US, the FDIC insures up to $250,000 per account. But if the entire banking system is in crisis, even insurance might not be enough. During the Great Depression, many banks failed before deposit insurance existed. People lost their life savings. Today, we have better safeguards, but a severe enough crisis could overwhelm them. Diversification is important. Don't keep all your money in one place or one type of asset. Spread it across different banks, different currencies if possible, different types of investments. Some people advocate holding gold or other precious metals as insurance against currency collapse. That's not crazy. Gold has held value through every crisis in history, but it's also volatile and doesn't generate income, so it should be part of a diversified portfolio, not your entire strategy. Real assets can provide some protection. Real estate, if you can afford it without too much debt. Productive farmland, even things like art or collectibles, though those are for wealthy people. The idea is that these physical assets retain some value even if currencies and financial assets collapse, though real estate values can certainly fall in a crisis too, especially if no one can get mortgages. Skills and human capital are ultimately the most important. If the economy crashes, what matters is what you can do. Can you grow food? Fix things? Provide services people need? The more self-sufficient and skilled you are, the better you'll fare. This sounds like survivalist thinking, but there's wisdom in it. Economic crises throughout history have always been weathered better by people with practical skills and diverse capabilities. Politically, people need to pressure governments to address debt before crisis forces the issue. This means being willing to accept some pain now to avoid catastrophe later. It means supporting politicians who are honest about the problems and willing to make tough choices. Unfortunately, democratic systems don't always incentivize long-term thinking. Politicians focus on the next election, not the next generation. But citizens can change this by rewarding honesty and punishing pandering. Let me tell you what I think is most likely to happen. I don't think we'll see one dramatic collapse. More likely, We'll see a series of rolling crises. One country gets in trouble, gets bailed out, or restructures, things calm down. Then another country hits problems. Each crisis is managed, but with increasing difficulty and at increasing cost. Government debt keeps rising. Growth stays sluggish. Living standards slowly decline, especially for younger generations who inherit this debt burden. Inflation periodically spikes as central banks try to inflate away debt. Interest rates stay volatile. Financial markets experienced frequent crises and corrections. This grinding scenario might actually be worse than one big crisis, because there's never a clear moment where we hit bottom and start rebuilding. It's just a slow decay. Japan's lost decades might be the model, not collapse, but stagnation. Young people unable to afford houses, wages that don't keep up with living costs, retirement ages pushed higher, benefits cut, a general sense that things aren't going to get better. But there's also a possibility of reform, that we learn from these problems and fix them before catastrophe hits. Some countries have managed to reduce their debt burdens through responsible fiscal policy. Canada did it in the 1990s. They cut spending, raised some taxes, and brought their debt under control. Sweden did something similar. It's possible. It requires political will and public support for difficult measures. It requires honesty about the problems and shared sacrifice to solve them. It requires thinking beyond the next election or the next quarter. The alternative is waiting for crises to force the issue. And the problem with that approach is that crisis solutions are often worse than preventive measures. In a crisis, you don't have time for careful planning. You make desperate choices. You bail out powerful interests while ordinary people suffer. You risk social and political upheaval. Better to address problems before they become emergencies. Here's the bottom line. The global debt situation is precarious. Multiple major economies are carrying debt loads that are unsustainable in the long run. These economies are deeply interconnected through trade, finance, and debt holdings. If one major economy has a debt crisis, it will cascade to others through the mechanisms we've discussed. Banks, derivatives, asset prices, psychology. The last time we faced a crisis of this magnitude, in 2008, governments and central banks had the resources to mount a massive response. They barely prevented collapse. But the cost was that they depleted their ammunition. Debt levels are now much higher. Central banks have less room to cut rates. Governments have less fiscal space to spend. If another crisis hits, the tools available to fight it are much more limited. This doesn't mean crisis is inevitable or imminent, but the risks are real and growing. Anyone who tells you they know exactly when or how it will happen is lying. Complex systems are unpredictable, but we can see the stresses building. We can see the warning signs, and we can understand the mechanisms by which one country's debt problems can become everyone's nightmare. The house of cards is getting taller and shaky. One strong wind might be all it takes to bring it down. The question isn't whether we're vulnerable. We clearly are. The question is whether we'll address it before that wind arrives, or whether we'll keep adding cards to the pile and hoping for the best. The next video reveals the financial collapse signals that experts are quietly preparing for right now.